moment, I am of the view we really have two quite separate stock markets. And the one that I'm going to mainly focus on is the speculative mania that we can now clearly see in growth stocks. The symptoms are pretty obvious to all. Globally, we have an IPO market that is extraordinarily excited, money being made on just the ability to get an allocation. Is completely consistent with other excited bull markets of 2000 or Asia in the 90s. We have high level of retail activity, whether we see it in the options markets or the Reddit threads, the stories of fortunes made and lost in short time. A good bull market you wouldn't have without innovative financing vehicles. This time it's the special purpose access companies where you hand over your cash on the basis that the manager is going to buy something special for you at some point down the track. The signs are everywhere. But the most important of these are probably the extraordinary valuations we're seeing in a large number of companies in the growth area. And be clear, I have no question, I'm not questioning for most of them the extraordinary prospects of them. But I'll just give you the simplest example, one from the local market, and that is Afterpay. I have no questioning the extraordinary achievements of the company, the fact that the product is loved by both the consumer and the merchants. But on achieving, let's say, something of the order of 40 to 50 billion in GMV, probably not next year, maybe the year after, maybe the year after that, this stock will be trading on any sort of reasonable assessment of its final profitability of around 100 times earnings. Now, then you have to go on and keep growing from that point. And 40 to 50 billion is a big number. We just simply know in history, even if Afterpay is the one that justifies it, buying stocks on 100 times earnings 2, 3, 4 years out is a great way of losing money. When I talk to clients, I hear a lot of acknowledgement of the craziness of whether it's the Teslas, the Afterpays, the Shopifys. People are happy to accept that doesn't make that much sense to them, but then they gain deep comfort in the FANGs or in Microsoft. These, to everyone's mind, are bulletproof businesses, and I agree. I'm not here to throw any, I can see flaws in them, but I'm not going to throw any great mud at them. But I can tell you what, the valuations are 50 to 70% higher than they were just a few, less than 12 months ago. And very little has changed for these businesses, even with the move to greater e-commerce in most cases. We've been here before. We know how the movie ends. And for those joining in now, well, the outcome is that you're just going to lose substantial capital from this point on. There is a rich opportunity on the short side, though I grant you, given the difficulty in timing, it's a difficult one to manage. For the rest of the market, we have a more traditional stock market. In the midst of a significant recession, any businesses showing any degree of uncertainty, whether that's a result of cyclicality or by the fact that it's been challenged by the nature of this downturn, these stocks, by and large, have performed poorly, even though they have bounced off the lows. Our expectation is broadly that as the economy recovers, and the economy will recover, even with fits and starts, I mean, already clearly has come a substantial way, that the market will, for these stocks, anticipate a better time ahead. Of course, there'll be some changes. Not everything will go back to where it was, but in this area, there are extraordinary opportunities. So in terms of where we see them, we continue to see great opportunities to buy Chinese consumer names. Companies like Li Ning or Anta Sports, who compete with Nike and Adidas in the sportswear market in China, and companies growing at 30% type rates at the top line and bottom line. And while these stocks have done well for us, and I'm not unchallenging valuations more around the low 30 times, we assess them as having years of growth to come. The semiconductor area, whether that's DRAMs or radio frequency chips for mobile phones, we have ongoing investment in computing, in 5G, that will drive these businesses. They're no longer on the very low valuations they were at the end of 18 or in March when we were adding to them. But again, you're buying companies with good growth prospects. In the case of the more cyclical ones like the DRAM producers at around 50% over book value. These are the most leading edge modern semiconductor fabs in the world that you're buying at that price. Or the more traditional sort of growth type companies like a Skyworks or a Microchip, you're paying high teens multiples. We've also used the opportunity to move into high quality travel names, whether that's an Amadeus that runs the booking systems of the airlines globally, or Booking.com, the world's largest online travel agent. These businesses obviously challenged by the travel environment. We absolutely have the view that travel returns over a period of 3 years or so back to where it was and continues to be the growth business it was. And against their peak earnings, clearly they got very little in the way of earnings, but these companies have had the ability to cut costs dramatically, so they're not bleeding at the moment. And against their prior peaks, they're around high teens multiples. These were companies people were prepared to pay up highly for prior to this. And there's a range of companies in this area that we're invested in. To just finish, I'd say the parallels to 2000 are extraordinary. There are many out there who are writing at length to say how it's not the same, with a number of points of difference they're saying. Well, obviously interest rates is one, but the other is that 2000 was about the pets.coms, the PowerPoint companies that had no substance to them, whereas here we have, you know, companies with extraordinary prospects in front of them. But what I'll tell you is 2000 was not about pets.com, it was about Microsoft and Cisco trading at 70 times earnings. Two stocks that ultimately lost you the best part of 90% if you held on to them for long enough. I think it's not like 2000. My comment is simply this: you weren't there. It's never exactly the same, but the similarities are extraordinary.